Thank you for joining us this evening on Lendlease Global Commercial REIT. I'm Min Hui from ProsperUS, and I'll be your host for tonight. So let me introduce the speaker for tonight. We have Kelvin Chow, CEO of the manager. He has over 27 years of experience in accounting, finance matters, tax and treasury, and capital management, of which more than 60 years are in direct real estate investment and fund management. Prior to joining REIT, he was Managing Director of Investment Management in Asia in Lendlease Investment Management Private Limited. Before that, he was the Chief Financial Officer of various REITs, where he played a vital role to oversee the company's financial activities. Next, a brief introduction to ProsperUS. ProsperUS is a digital investment service catered for the millennials. We aim to provide you with the best-in-class service, and to allow millennials to gain more insights on investing, we have specially curated webinar series. So with ProsperUS, you will not only learn how to invest, but also enjoy curated lifestyle experiences at the same time. ProsperUS is also now available on Google Play and App Store today. So start investing on the go with ProsperUS. In addition, don't forget to follow us on our social media to keep yourselves updated to the latest news. Without further ado, let's start tonight's session. I'll now hand over the time to Kelvin. Over to you.
Thank you. Yeah, hi, good evening, everyone. My name is Kelvin Chow, CEO of Lendlease Global Commercial REIT. Today, I will give you a brief introduction of our third Q business update. At the same time, after the presentation, happy to take up any questions from the audience. Let me start with the presentations. Okay, basically we have successfully acquired 100% of GEM in April 2022, and we believe this is a good asset that it will strengthen our portfolio. It will very strong and stable cash flow for the unit holders. And with the acquisition of 100% of GEM, we will achieve the tax transparency, which again provide a higher distributions to the unit holders. And that based on the historical P&L, we will have a saving of around 5.6 million per annum. And as the profit and loss or as the cash flow grow, I think the saving will be higher, because that is literally the tax that we can save, and then we will be able to distribute up to the unit holders. So we also successfully launched our sustainability links loan, and this is the largest among Asia, and it links to something we call the sustainability performance targets, which if we achieve, it means it will be a saving for the borrowing cost, which I think we are very confident to achieve that, and that likewise will improve the distributions. With the enlarged portfolio, we will be able to increase the investor interest, because we are in the NARIF index, and a lot of indices investors would like to actually invest in REIT within the index, and I think that benefit us with a more sustainable kind of trading price. So we done through a few fundraising, and also we issue perps, and with the loans that we have together make up around 1.7 billion in terms of cash in terms of fundings to fund the acquisitions. Next, please. Okay, of course, the acquisition was done after the quarter and 31st of March. So in the case, this number doesn't include all the matrices from GEM. So it's purely just the portfolio, which is on 313 and also Sky Complex in Milan. The portfolio occupancy remained high at around 99.9%, and as of our financial year going to end by June, we managed to effectively de-risk all our leasing renewal risks, and we only left around 1% based on NLA or 3% based on GRI. So we have sufficient liquidity to meet our debt obligations, and happy to share with you that we actually hedged 90% of our borrowing. So in that case, in all kind of fluctuations due to the uncertainty of interest rate, our position is secure. and post acquisitions, our gearing will be at 40.7% level. So the portfolio currently have a weighted average lease expiry of 8.2 years, and the tenant retention is 71.1%, which is relatively high compared to the peers. Gearing level 27.7%. Our debt running cost is still remaining relatively low at 0.98% per annum, and we achieve an interest coverage ratio of around 10.3 times. Next, please. The portfolio is performing relatively well. As I've shared with you, we have managed to successfully de-risk most of our lease expiring this financial year, which is FY 2022, which bring our exposure to only 1% based on NLA, 3% based on GRI. And if you look across the subsequent years, actually it's quite well staggered up. So that in the case, in any one year, there's not suddenly a high renewal risk that exposed to the unit holders and affect the cash flow or distributions. So our portfolio occupancy for the past 2 quarters has been was around 99.9% and is always stay around 99% for the past few quarters. Next, please. We zoom into 313 at Summerset. The occupancy rate likewise maintained high at around 99%, and the latest is was around 99.4%. So we proactively doing our deploying our marketing strategies, and we managed to bring in a few new retail concept to the mall. And we have the Korean Express facial, which actually you can do a facial relatively quick within 30 minutes or so. And likewise, we bring in some blanket and other choices of selections to the mall. Next, please. The tenant sales maintain relatively healthy, although there are some strict tightening of the number of people to be able to dine together. But I think for us, I think it's still a relatively healthy number. And happy to share that based on because of the reopening of the government, relaxing of the government's measures, I think we actually achieve a good year-on-year April numbers for this quarter, for this April. Next, please. Okay, so back to our asset in Milan. Basically, everyone was very concerned about the rising electricity utility costs and how it affects the operations. We are happy to share that for our asset in Sky, which is in Milan, is a triple net arrangement. So basically, what it means is that the tenants will bear for all the costs pertaining to the operations, and basically, while the costs were to increase on operations, the tenants will pay for all the costs. So what we receive from the tenants is a good cash distribution to the unit holders. And at the same time, we do actually peg our annual rental escalation to the CPI index. And of course, as inflations rise, CPI index will also increase. So we are expecting our rental revenues to be higher, while we are not suffering from the higher operating costs. I think that is a win-win for our unit holders. And we also managed to structure the cash flow flowing back to Singapore in a very efficient way, and there will be no tax leakage from the distribution back to Singapore. What it means is that if you receive $100 from the tenants, we were able to send it back to Singapore for distribution, $100. I think that is simple to understand. Next, please. Okay, on our capital structure, basically our borrowing maintained relatively healthy. It's about 600 over million, which means the gearing is about 27.7%. So with the acquisition of GEM, it will bring the gearing up to 40.7. It's still relatively low compared among the peers, but we will continue to sort of try to bring down the gearing in order for us to have higher headroom for next acquisition. The weighted average debt maturity 1.8 years, and as I have mentioned, the running cost of debt is about 0.98% with an interest coverage ratio of 10.3 times. Next, please. So this is basically our debt profile. You can see that that's how the debt will be stacked up, and also how the debt will be stacked up after the CIMB acquisition with the shaded I think shaded cubes stacked on to the next few years. So what happened is that at this moment we are 90% hedged on our borrowing, and we do actually have our investment in euro, and we also borrow 100% in euro to fund the acquisition. So in that case, there's a natural hedging to prevent any fluctuation of balance sheet, and also preserve the values of the balance sheet. So as for the income back from our Milan asset to Singapore, we do a forward hedge, and the forward hedge position that we have is around 2 years forward, and basically we are in the money at this moment. So we continue to have provide enough debt facilities for future acquisition. At this moment, we have around 1 billion, and of course, 860 million has been used for our CIMB acquisitions. Next, please. So how we actually reach out to our shoppers is that we have this loyalty apps called Lendlease apps, which basically we continue to maintain the loyalty kind of programs to some of the members, and we managed to actually build a very good member base. At the same time, use this app to push up some kind of promotion and sales to entice, first of all, the members, and also to help our tenants to promote and sales some of the product and services through the apps. Next, please. Okay, of course, everything equal. So how do we actually preserve investor values? Actually, is through our ESG achievement and commitments. We believe that as we move forward, ESG and sustainability become a key focus to the investors, and it's important for us to start to plan now so that we can future-proof the value of our asset and also the cash flow. So what we do is that when we acquire the asset, we do actually make sure that the asset is actually a green and sustainable asset in terms of some of these ESG targets and all those things. So as you can see, the property that we have are on Green Mark Platinum, or either they will also achieve this Universal Design Gold Mark Plus. And we just recently secured the sustainability loans of 860 million, and we focus on reduction of water usage, reduction of waste, and also we make sure that we also be able to focus on reducing energy and carbon emissions. And we are very active in creating social values to make sure that we also put ourselves in, contribute back to the societies as and when we can. Next, please. So these are a few of the targets that we like to share, but I will not elaborate too much of it. Basically, this is what I've just described, just that in terms of you just provide some targets of what we are going to do based on, for example, reduction of energy and greenhouse emissions. Basically, we are looking at 20% reductions, likewise 22% reduction on water, and 11% reduction, 11% recycling rate on the waste. Next, please. I think looking forward, what we are trying to do is that we continue to build on a portfolio to make sure that our portfolio are resilient and able to provide sustainable returns to the unit holders. We actively manage our capital management to maintain a lower cost on borrowing, and likewise maintain a reasonable gearing levels to have a comfortable level by the unit holders. And of course, most importantly, bring in high quality assets with stable cash flows, and that facilitates us on our distributions, and never to forget to create values into the communities, which then we will deepen our stakeholders engagement. What we can do is that we will leverage on technologies to build in some integrated shopping experience. Likewise, communicate actively with the tenants to sort of help them to grow the business. Likewise, we'll bring in enough of sales and footfall to the mall. And we will continue to drive sustainable business growth, and likewise through targeted marketing campaigns to boost sales. Next, please. I think we can skip this. Next, please. Okay, I think I have completed my presentations, and I think happy to take any questions from the audience. Thank you.
Thank you, Kelvin, for presentation. Just like to give a reminder, so if you have any questions, do put them in the Q&A function at the bottom of the Zoom platform. Okay, so let's see what's the first question we have on the floor. So the question raised was 90% of the interest is hedged to a fixed rate of. I think this was mentioned near when you were at the slide of debt facilities and maturing profile. I'm not sure if they were referring to that, but that's where I saw you mention.
Yeah, that's right.
90%.
Yeah, the 90% hedge as at 31st of March is 0.98%. Yeah, that is the average cost, but if you base on the hedge, and because you only have like 10% exposure, you can take that as the hedge rate as it is.
Okay, thank you. Let's move on to the next question. Okay, how do you see the retail market in Singapore playing out? Isn't the Orchard area more reliant on tourist foot traffic versus suburban malls such as CGS-CIMB?
Yeah, as from what I have observed from the number that we collected after the reopenings announcement from the Singapore government, I think we see the sales number, the footfall has been picked up substantially. Actually, I'm looking at around the double-digit growth in terms of sales number and likewise footfall. So I believe that is very good for the retail scene, and it will only benefit the retail operators with the reopening of Singapore. Likewise, the loud travelers come back. And to be honest, most travelers come to Singapore, if they have time, they will certainly go to Orchard Road. So we believe that will also bring back the footfall and the sales to all the malls along Orchard Road, and definitely 313 will benefit from it. As to CGS-CIMB, I think it's less reliant on any kind of travelers because it itself has its residential crowd around the areas. At the same time, also has working offices and factories crowds around the area, which they already have achieved a footfall that is pre-COVID. At the same time, sales number that is exceeding the pre-COVID number by around I would say 14-15%. So they continue to be able to have a stronger number because that area continue to grow, and with the latest announcement of this new houses from this Tengah Forest district, I think we're going to increase around 42,000 kind of household. At the same time, with the development of this Jurong Innovations District, also bring in a lot of working crowds. And also, to people that actually know about CGS-CIMB, there's another development called the Perennial Business Center, which expect to be completed by the third or fourth Q of this year. And again, that is a link directly to this business center. And again, it will generate, you will channel a lot of crowd to the shopping mall. So all these will only continue to build in the crowd and sales to the mall. So I think CGS-CIMB of less of a concern. Of course, the reopening do actually help in a way because it brings people back to the office, when I think surrounding CGS-CIMB, there is a lot of offices, which again, that will benefit the CGS-CIMB in terms of traffic and sales. Thank you.
Definitely, I agree on that. That it's gonna be more stable, even there is or without like the tourists.
Yeah, that's right.
Let's move on to the next question. Is there any plans to reduce the cost of capital? The PERP security seems to be commanding a pretty high interest.
Yeah, I think certainly if there are plans or there are ways to reduce the cost of capital, we will do so. I think, and we are the one that we are one of the REIT that is very active to try to maintain and reduce the cost. I think you can rest assured that we will be doing that. As the cost of PERP, I think we try to pack it with the equity cost, which is also relatively high of around 6%. That means our DPU yield is around 6%, which is, I think, among the peers the highest. And if that compared to the PERP's cost, which also equity traded kind of funding, I would say that is cheap. Yeah, but you're right that if you say you classify that as a debt, then it's relatively expensive. But that PERP do actually facilitate us to actually tap onto different lenders or different fund agency to actually sort of like to reduce the burden of the existing banks lenders, which then that's how you sort of like maintain the kind of different source of borrowing to help you to maintain the equal level of kind of funding structure. I think we do certainly want to bring down the cost, but PERP is not something that is damaging, but we feel that it's something that we can sort of help to manage a more even spread of funding structure.
Okay, thank you. Let's move on to the next question. How long is needed to digest CGS-CIMB acquisition before another round of acquisition?
I think we don't actually feel that CGS-CIMB is an asset that is very difficult to understand, and we believe that the performance for the next few quarters will certainly be able to improve with the inclusion of CGS-CIMB. So I would say that if let's say we are able to demonstrate the positive improvement of CGS-CIMB, be it from the valuations of the asset itself and also from the performance of our distribution through with the inclusion of CGS-CIMB, I think that will certainly help us to sort of position ourselves for the next acquisitions. So likewise, back to the earlier question about our cost of debt and also on the PERP issuance, I think it's a way for us to structure it more evenly, so that in that case, in any part of times, we are not too stretched on debt capacities in a way that will limit us for the next acquisitions. Likewise, we do some of the PERP to sort of ease out some of the position. And also to the more earlier question is that whether we were going to do something more than just to bring down the cost of debt. Certainly we will, and we will certainly do something to sort of smoothen out the debt profile itself.
Totally agree. Regarding the expansion of 313, what is the progress of the works? Are we on schedule?
The expansion of 300, I believe you are talking about the additional prop ratios, which we are slowly deploying it, so that in the case we try to deploy on the lower, because we do actually have an additional prop ratio of around 10,800 square feet given by the government. So we're slowly deploying it. I think at the moment we already deployed 700 square feet of the space. So that in that case, that will certainly help to increase the cash flow distribution to the unit holders, because these are free money. As long as we deploy it, I think we will be able to unlock more cash flow distribution to the unit holders. But then in that case, the next question is, why are you not deploying everything now? I think is that we try to deploy at a floor that we can command higher rental. So that is to maximize the return to the unit holders. Of course, we can do an easy fix by just deploying everything at the car park, and then but the car park is somewhere on a high level, which I think probably that is where less people will go up to the level and the command of the rental is lower. So we try not to do that. I mean, that's an easy fix, but we try to actually do something that is more beneficial for the unit holder. So we are still looking at ways to sort of put the additional space to the mall as and when there's a renewal of the existing tenant, so that as to reduce the disruptions from all these deploy of new space, which will means holding up and also affecting the sales numbers on during that moment. So we try to actually make sure that we are able to sort of reduce the disruption, but also improve the returns while we deploy the space. But of course, I'm not sure also you are talking about the expansion of 313 relating to our redevelopment of the Grange Road car park. I think if let's say that is your questions, I think we are also doing we are also progressing relatively well. But of course, one of our key tenants that we want to anchor on the space are also going through some process of approvals from the authorities in order for them to start their construction. So far it's relatively well, but of course COVID do actually cause some delay and also cause some higher cost, but I think everything is still manageable. We are still looking at it as a very positive kind of yield accretions when it completed, and it will certainly be a very good attractions to draw more crowd and footfall and likewise sales to the precinct, and it will benefit not only 313 but also I think other malls around the area. But of course, being 313 is the nearest to the development, we will certainly be we will certainly have a lot of synergies to sort of improve on the footfall and likewise the sales. Yeah.
Thank you.
Thank you.
Let's move on to the next question. Is there a fundraising moratorium after recent EFR for CGS-CIMB?
As far as I know, there's none, because every time if you want to do a certain sizable acquisition, you will certainly seek XGX approvals to max up your size and all those things. So I think so far there's none. But of course, for the sponsor that actually subscribe to the additional units that we issue during the acquisitions, I think they have to hold for I think the max of 1 year. So that is how it's been managed, because this is a related party transactions.
Thank you.
Thank you.
Moving on to the next question. Are there any restrictive covenants imposed that could impede future acquisition?
There's none, but I think we do actually set some expectation in the prospectus when we do acquisitions. I think basically there are 4. I think one of it is that when we acquire asset, there has to be at least 80% filled. That means there's 80% occupied. So that in that case, when we bring in, it means that when we bring in an asset, it already start generating income for the distribution and for our unit holders. So they shouldn't have any major AEI works that is to be done within the next 2 years. So what it means is that we do want to continue raising funds from the unit holders or draw down debt from the banks to sort of facilitate this sort of AI works, which again might not then in that case during our acquisition reflect the true distribution performance to the unit holders. I think thirdly is that when we acquire asset, the asset has to be on the market rate. That means this asset is not overpriced because the market rate is high during then with a higher lease, higher rental rate during then, and then value that end up the asset is valued higher. But actually, if you look at the market rate, it certainly doesn't warrant the kind of valuation price that we're paying. So in that case, that's why it has to be on the market rate kind of acquisition. And thirdly, the fourth criteria is that we must make sure that when we acquire the asset, this is an asset that I think at least the acquisition or the market sentiment is actually relatively good for us to acquire the asset. Because for example, you talking about acquiring an asset during maybe for example in a country that's having war, I think that doesn't make sense for us to acquire that kind of asset in that kind of region. I think we have to make sure that the micro and macro environment is good for us to acquire the asset at the same time is something that is easily acceptable for us to acquire the asset based on the region that we try to target. I think these are the 4 criteria we set in the IPO prospectus to make sure that we carry out our acquisition in a disciplined manner. Yep.
Thank you. Moving on to the next question. Other than GEM, any further acquisition of Singapore-based assets in the pipeline? Read
I
from
think-
some analysts report that PRQ has reached rental stability and is likely ripe for absorption into the REIT.
Yeah, I think Singapore will continue to be a country that we would like to expand our presence, and we always hope that while we expand ourselves, we will still be a REIT that proxy to Singapore asset. So we will continue to acquire Singapore asset, and basically you're rightfully pointed out, PLQ could be one of the asset that we can consider. But of course, if you look at the overall size of PLQ, it's about $3.6 billion. So it will be a big acquisition if you acquire that asset in one shot. But the thing is that when we build the asset, we actually already break the asset into 6 strata titles. So what it means is that you can acquire by strata title basis, and you can still enjoy the tax transparency treatment. So the mall itself has 1 strata title, and there's 2 offices just next to the mall as also each one has 1 strata title. And the office across the road, which is we call it PLQ3, has 3 strata title. So based on that, if any strata title, the renter on that strata title has reached a very stable kind of cash flow at the same time is accretive for our acquisitions, we can consider that. And certainly that is also a kind of bite size for us to acquire that instead of a whole asset that we acquired in just as GEM that we do. Yeah, so I think that we technically forward plan that kind of this sort of action. So in that case, when we acquire, I think we can actually manage it in a more systematic manner in a way to slowly acquire the asset.
Thank you. So are we going to see any like acquisition of PLQ in the future?
I think certainly we will, just that it might not be immediate, and also all has to be at the right price, and also something that we feel that when we acquire is benefit to the unit holders. So and also just to share, Lendlease doesn't own 100% of PLQ. Actually, it's a joint venture with another private fund investors. So again, everything has to go through a negotiations. But for us, we certainly want to have the best benefit for the unit holders. So we can actually touch base with these fund investors to sort of check on their whether they are interested to sell. But I think everything is manageable because likewise, GEM is not likewise GEM is not owned 100% by Lendlease. We only have a very miserable stake of around 10% effective, and the rest is held by around 11 other fund investors. But as long as we feel that the asset is right, we will certainly take more aggressive negotiation with the investors to make sure that the asset is put into the portfolio. So I think this one we certainly be able to manage, just that we are more concerned about the cash flows, that whether it reached the stabilized and also it reached the kind of accretions that we expect before we bring into the asset, because bring into the portfolios. I think these is the things that we want to assure the investors that what we bring in will certainly continue to be able to generate good revenues to the investors.
Okay, thank you. Moving on to the next question. Can you share how One Nation's adjacent entertainment project integrate with 313 property?
I think while we are all within the Summerset precinct, I think there's something that we need to sort of like reach out to them and see how we can sort of collaborate. I think certainly we are happy to see how we can have some joint collaborations, joint promotion and joint activities to work together. Of course, we are not mandated to do any kind of collaboration, but it's definitely benefit us, the shoppers, and also people that come down to Orchard Road to have some collaborative activities together. to sort of get people to draw people to the pristine. I think that's something that is always something that we consider even before they award one nations on the site. But again, we have yet to touch base with them, but we're happy to see how we can sort of collaborate with them to have some joy activities, the kind of things to bring in more crowds.
That sounds good. I'll look forward to the collaboration.
Yeah.
Moving on to the next question. Okay. Parkway Parade has been under Lendlease management for several years. What prevents its absorption into the REIT? And then the second part, both PLQ and Parkway Parade are huge assets and likely transformational. Will it necessitate disposal of Sky?
Okay, right. PLQ has been managed by Lendlease for a while. Nothing prevents it to absorb to the REIT, but remember the 4 criteria that I spoke about earlier. I think Parkway Parade is still under some AEI work because of the connecting. They are trying to connect it with the train stations and some major shift of the tenants and all those things. So I think that is something that means that we will not consider it based on what we have shared in the IPO prospectus for the time being. So the next question is that sorry, I missed the next question.
You mentioned that both PLQ and Parkway Parade are huge assets and likely transformational. Will it necessitate disposal of Sky, the complex in Milan? Is it?
I think we will assess the asset on an individual basis, whether to continue to hold an asset or we dispose it. And if let's say we have maximized the cash flow and we are able to divest it in a very positive valuations uplift, so we will consider that. So you might not need to divest Sky in order to acquire the asset for sure, but it just means that you continue to build a bigger portfolio, which I think is no harm to the investors. It also means added diversities to the investors too. Because at this moment, Sky is just at a triple net, triple A bonds that we have continue to give us a very good stabilized cash flow, which I think is proven to be a good asset during the COVID period, which 313 has its challenges because of the lockdown and all those things. But Sky has, while they actually also having lockdown on, in Italy and Milan, they continue to give us a very good stable kind of renters, and also with the rental escalation on the year-on-year, they continue to pay a higher rental kind of things. So far, this is a very good tenant, and to be honest, it's actually 100% owned by Comcast, and Comcast is a AAA kind of tenant, which is better than the credit ratings of Italy as a country itself. So I think to us, it's holding a AAA bonds for another 10 years up to the lease expiry. So I think it's a very safe and secure cash flow. So we will not divest the asset easily unless we feel that we already up to the max of what we can do for the assets.
Okay, thank you. Next question. Many investors right now are moving towards ESG portfolio. How does the older mall continue to keep up, or is there a need for major refurbishment to meet the investors' expectations? Yeah,
I think it's a good question for older mall to continue. Of course, first of all, just to let the audience know that our mall actually is only like 10 years old. I think around that, so in that case, it's not considered as an older mall. Yeah, but I believe that the older mall has to continue to see how they can sort of slowly integrate some of this ESG or energy saving kind of initiative to the mall. Although some of the mall doesn't actually structure well to sort of be a strong ESG proven kind of asset, but they can able to do something. For example, the improvement of maybe some solar panel, or maybe they could actually do in some electricity energy saving kind of light bulbs and use this sort of auto switch off kind of mechanism to reduce the usage of the, for example, electricity. Likewise, the water. I mean, if let's say it's not used, I mean, there's auto sensor to reduce the usage if let's say people are not using it. And I think that will certainly help to sort of improve the credential of from the ESG perspective, though they cannot be 100% proven that they could be effectively ESG effective. But I think it's more to try to see what you can do, and likewise, I think in the process also see how you can recycle some of these assets that you have to sort of like, and then probably hopefully you can build up a more healthy portfolios. I think there's no one solution to solve everything, especially the older malls really have to depend how committed is the owners to the ESG effort. I think if they do actually try to pay more attention, they could also actually look at some of these backup generators actually to replace some of these generators with other kind of alternative power sources, so that in the case to reduce the way they actually consume these fossil fuels to generate these power generators. All this can be done, and see how much you can sort of reduce and put your to reduce and improve on your positions. Older mall can still do something, but of course they cannot be do as good as the new mall. But still, I think if as long as they've proven that they are do something, I think the investor will certainly support them on the initiative and continue to stay invested on them. Just like I did actually ask the same questions to one of these head of Citibanks, I think 2 days ago. How do you actually make Shell or this sort of petrol company ESG, or how do they prove to them, that prove to the investor that they are going to do something on the sustainability, because they use so much. I mean, they technically are not going to be a kind of they technically are going to have this carbon emissions and everything through the way the business is being operates. So I think the response to these city bankers is that as long as they show the roadmap of how they're going to commit themselves and how they're going to reduce in terms of the carbon emissions and how they actually reduce the kind of wastage that they have, I think investors will appreciate that and also will be able to support on the initiative and continue to believe in the companies. I think that's what we should move forward to. If let's say if an old mall, just try to do what you can. I mean, people will understand, but it might not be perfect, but it's still effort put in to sort of maintain a good ESG profiles. Yeah.
Thank you. Moving on to the next question. Cap rate for GEM office space. How is the rate compared with other nearby offices?
I think the cap rate for the office is around, if I'm wrong, is 3.5, which I think is the same to our neighbor office mall. I think so that one is quite stable. And don't compare us with another buildings, which is actually the industrial building or B21, B2 kind of building, because those are not directly compatible, because those buildings are of a shorter lease, probably around less than 60 years lease. But for us, it's a real office building which is of a 99-year lease. Of course, then if you compare that, then the cap rate will be different. If you compare on the office building in the regions, our cap rate is reasonable.
Okay. I think we have one final question from the floor. Let's wait for it. Okay. One worry for investors has always been the tenant concentration risk of Sky Italia, given it occupies 100% of Sky Milan. How will the recent GEM acquisition mitigate that risk? Anything else you can share about how Lendlease manages that risk?
Okay, I think to us, yes, I mean, there's always a concentration risk if let's say you only have one tenant on a buildings, but you also provide stabilities. If let's say this tenant is a strong tenant and they actually have committed themselves to heavy capex to sort of secure the premises and continue to invest in the premise to sort of like, and likewise continue to operate positively. So yes, I mean there is always a single tenant risk, but to us, I think I think the risk for Sky is actually relatively low because we see that they have committed around 15 million kind of euro dollars on the premise, and at the same time, you know, the trade union law in the Europe country is probably very hard to deal with. So if let's say they were to move to other area, I think they also have to pay a hefty compensations to move people around. I think thirdly is that now Sky is actually paying around 180 euro per square meter per annum, and based on the latest buildings that is adjacent to Sky, and the rate that is paid by the tenants is around euro 320 per square meter per annum. So Sky do actually have an advantage of the current rental rate. Yeah, so because they have the first mover advantage, they have been there for around 10 over years. So they do still enjoy a very good rate. So in the case, the chance and tendency for them to move is also relatively low. So based on these few factors, we feel that while we are released to Sky as a single tenant, but the risk technically is well contained, and we believe Sky will continue to use the space for their regional operations. Then they technically have moved some of the Europe operations to Sky that we have. So in that case, it continues to prove that they want to use that space for in a long term to be a regional office.
Thank you, Kelvin, for sharing with us about Lendlease Global Commercial REIT. Do you have any final questions final words for our participants today?
Actually, thanks for participating in this forum. I mean, for those that participate, of course, I mean, you all like to know more about us. I just want to share that with the acquisition of GEM, our portfolio is really going to be stronger and more stabilized, and we are very confident that we are able to continue to deliver a very good kind of distributions, and that is something that we want to continue to do so to bring confidence and trust by the unit from the unit holder that we have. And also we believe the valuations will pick up with the reopening of Singapore, and likewise that would mean a positive uplift of the values, be it for GEM and also likewise for 313. And Sky, given that you are going to adjust its renter based on the renter based on the CPI index, higher of CPI index, likewise we believe Sky will also have a positive valuations to be reflected by this coming year end, which is in June, which is another 1 month or so to go. So continue to support us, and we will certainly be able to prove to you that we are able to deliver the right value propositions for you. Thank you so much.
Thank you everyone for joining. So do remember that we have an upcoming session on UK stocks, the land of dividends and value. So just scan the QR code on the screen and you can just register for it. Thank you everyone for joining today. Thanks, Kelvin.
Thanks, bye-bye.
Bye.